Hey, greetings and welcome to the November Investment Strategy Brief. You know, it's that time of year where we're going to take a look into 2022, sort of what are the transitions into 2022. So let's jump in. Now, as it relates to these sessions we've done every month, of course, we anchor it in our outlook. And over the year, we've been talking about, a positive view that we've had for 2021. But let's take a quick look, and I'll show you a preview, if you will, of the things we're at least thinking about for our 2022 outlook. I think the first takeaway, really, is the idea that the recovery remains intact, meaning we'll see above-trend growth next year. That's what we think. We also see the year as a transition or a turning point, almost like a year where we're moving from one state to another. So, for example, we're in a pandemic, and we have to ask ourselves a question: is there a decent chance we'll shift from sort of a pandemic to an endemic state for COVID-19? Obviously, vaccinations and people having gotten sick and building natural immunity will all contribute to that. We also will see a big shift in essentially the level of support, both monetary and fiscal. And we're sort of capturing that, at least in the early thinking, in 4 Ps. Politics, so think things like the upcoming midterms in 2022. Policy, so both monetary and fiscal policy. The Fed obviously tapering their purchases, ending their purchases around middle of the year, then the open question of when they're going to start hiking rates. And then fiscal policy, really around the packages that have been done this year. Are they going to get done? Maybe Build Back Better gets pushed into early 2022. And then they're probably done for a while. And we'll see some focus on regulatory issues, et cetera. But anyway, think of it as a result of all that, policy kind of lightening up. We'll have a keen focus on inflation. And really, the ultimate question is whether the supply chain bottlenecks and the sort of outsized supply-demand issues that have been in place because of the frictions of reopening, whether that calms down and inflation ends up being transitory and in turn calms down. And then, of course, all of this leading to profits. Will we see increased taxes? Will some of these inflationary issues eat into the profits of companies? So earnings overall will be a keen focus, and we're going to be watching to see if some of these forces will create a transitionary state, if you will, for things like earnings. So just to kind of get you ready for it, by our structure and our calendar, we publish our outlook more formally the first week of January, so stay tuned for that. Now, part of it always is, again, the continued focus on risks. We talk about this each month. And, we obviously are watching things like the Delta variant and maybe other variants show up. But it seems like, in some ways, knock wood, that things are calming down with the pandemic and things like variants. And what has been in real focus, of course, has been the frictions of reopening and the result of that being higher inflation. So those are some of the risks that we're watching. We're going to get into it in this session. We stay focused on our major themes, everything from productive competition to fourth industrial revolution to managing through economic recovery, which is what we're in the middle of here. But let's take a quick minute and check in on a pandemic update. So here on page 8, basically a couple of charts that tell a story. We've gotten past this third major wave of the outbreak of the virus, and things have been calming down, and we're truly heading into the colder months and into winter, and that will have an effect potentially in terms of the spread of the virus. In turn, on the right side of this page, we see the buildup of both vaccine-based and natural immunity, and so the whole question is that march towards the 90% level and above. And so, the latest thinking is when we get into the 90 to 95% of the population being protected either through natural immunity or vaccinations, it will move more towards an endemic state for the virus. And again, that's what everybody's watching for. Now, as it relates to mutations, one of the things we've done over the last month is to go out and look at some of the research and experts' statements, really, that are going on about mutation. And the bottom line to this is the following. Most of the experts and the studies that are coming out are talking about the fact that mutations may calm down, number one, may, number two, still be resistant or have the vaccines be effective against the mutations. There's one group that's saying, hey, it's possible that a mutation may cut through the vaccine and they'll become less effective. But generally speaking, the mindset has been that we should be okay, again, knock wood, as it relates to mutations and how we'll handle all of that. As it relates to this march to 90% and above, here's a chart that just shows the progress of the U.S., Canada, and developed markets in Europe. And the bottom line is everybody's marching up towards above, and 80% and above towards 90%. So we'll see how that all unfolds. We always like to check in on mobility, and frankly, month over month, really no change. So things like grocery and pharmacy, retail, recreation, back to levels we saw before the pandemic, but both transit, so think commuting, and then workplaces still operating roughly 20% below the level that existed before the pandemic. So again, more room to see further mobility as it relates to commuting, buses, trains, et cetera, as well as people getting back into the office. Now, obviously, we evaluate the pandemic in part, there's a human dimension to it, but in addition to that, economic impact and market impact. So with that, let's take a look at the macro environment. So here's a chart we've looked at month to month to month in recent sessions. And, the bottom line here is we see on the blue bars on this chart is the actual sort of experienced annualized GDP quarter to quarter. A big disappointment in the third quarter, as we've discussed before. But the view continues to be on a consensus basis that we'll see above trend growth in each of the quarters of 2022 and in the fourth quarter of 2021. But the drama here, if there's drama, is that if we looked at this exact chart a couple months ago, all those green bars would have been a bit higher, right? So everybody's forecast about how well we're going to do has been dropping, and that, that's important to understand. When we look at sort of the cumulative growth of the economy, this dotted line on the left here at page 15 is basically the trend line. And then you can see that V-shaped move, the big decline in 2020, and then the big recovery we've been experiencing. We're not quite back. We've gotten back to even on sort of the level of GDP, but we're not quite back to the trend line. Think of that as happening probably in the first quarter of 2022. And so, this recovery has sort of led to a V-shaped getting back to the trend line that we saw pre-pandemic. Now, on the right side of the page, we're reminded that the consumption represents 2/3 of GDP. It's important. So when we take a look at what's going on with the consumer, a few data points we like to check in on. One is confidence and sentiment. Basically mixed messages. Generally speaking, people feel okay. They're very worried, number one, about inflation. Number two, worried about the future, the uncertainty of the future. So the surveys that we see kind of have people a little bit spooked, but generally speaking, they're feeling okay in today's environment. In fact, that's translated to, for example, continued higher levels of retail sales. So people are active when it comes to spending. So that consumption component of GDP seems to be holding up okay in the current environment. Savings is up above longer-term trends. Think relief checks that have been helping people. Therefore, there's some liquidity to continue that spending in the future. And then finally, unemployment. Unemployment is not at the record level we saw pre-pandemic, but 4.6% as of the end of October is pretty good, and it's certainly below the 20-year average. So think of it as the employment's gotten much better. There's some room still for it to improve. Now, another dimension is consumer net worth. This happens to be net worth of households and nonprofits relative to aggregate disposable personal income. And so think of it as this line, when it's going up, is a positive, right? That means net worth is increasing. You can see in the middle of the page here sort of the decline and sort of stagnant effect of the financial crisis back a little over a decade ago. And then if you look to the right side of this page, some choppiness in these readings related, of course, to the pandemic. Now, the good news is, as it relates to both real estate and asset prices more generally going up, means that net worth has been rising. Now back to the job impact. This is a chart we check in on each month, and basically the higher impacted industries, we're seeing lots of recovery. So for example, leisure and hospitality, over 8 million jobs lost, 81% of those recovered. And trade, transportation, utilities, basically almost or a little over 3 million jobs lost, 91% of those jobs recovered. So good recovery, but more work to do, if you will. Now, as it relates to the pattern of sort of job postings, we can get into the data of which industries and areas are posting jobs. How much has that changed over the last, year plus, meaning back to the kind of the lowest levels of the pandemic and pre-pandemic, really. And then how's it going over the last, let's say, month? And the bottom line is there are areas where obviously we're seeing people posting jobs, businesses posting jobs, and some doing more of that than others. So again, it's a certain dimension, if you will, of recovery that we're seeing. Now, when we look at the economy overall, I'll remind you that this set of exhibits on page 20, sort of designed to give us a view on trends, but also quick color coding gives us a quick visual on whether things are positive, neutral, or negative. And the bottom line is, in general, economic recovery's continued. Generally speaking, things have been positive. So you look at PMIs, for example, or things like the GDP estimates, or consumer confidence, as we alluded to. Yeah, they're basically a little bit above or well above sort of neutral levels or average levels. But then the real sort of culprit on this page is inflation. Inflation is heated up. Here we're seeing a CPI of 6.2%. And bottom line is that's well above where we want it to be. It's well above where the Fed wants it to be. As it relates to things we're watching that can be driving inflation higher, here are a couple examples of that on page 21. One is delivery time. So the time it takes for suppliers to get deliveries essentially is way up. So it's taking time for things to get to their end destination, and that's creating friction. Another example is really around inventories, all right? If somebody's got inventories on hand, they can pull on those to, either sell or produce the goods and services that they're producing. And the bottom line is inventories are really considered to be too low. A large percentage of companies are indicating that their inventories are lower than they would like them to be. So an important data point as it relates to that friction. So turning back to inflation in a broader sense, here are 9 different exhibits. They're all red, all well above the Fed's 2% target. And the bottom line is that, we've seen a big move of inflation here in 2021. So the threshold question is, well, where does it go from here? And, the bottom line is when we look at those break-even rates at 5 years and in 10 years, they've basically been hovering between 2.5% and just over 3%. So inflated above, no pun intended, above the Fed's 2% target level, and a bit higher than where it's been operating sort of in the early days of the pandemic and before the pandemic, but not outsized by these sort of market-based forecasts. So, the open question is, will inflation calm down or will the Fed have to act? When we break down CPI, of course, there's always a story to tell month over month in terms of the CPI print. This one breaks it down into a variety of different categories. You can see the weighting in the index, but the drama is at the bottom here. So lodging away from home, up over 22%, right? That's a huge number. Car and truck rentals, up quite a lot. So you can see some of the dramatic numbers feeding into this higher level of CPI, and of course transportation being a real anchor to that in this latest print. So with that, let's talk about Fed policy. They've got the dual mandate of price stability and maximum employment. Price stability means keep inflation under control. Maximum employment means keep things going to try to get people more jobs. And those two things kind of push against each other. So the things they're thinking about include inflation. Inflation they've acknowledged as being higher. They still attribute it to the frictions of reopening. They still describe it as transitory, but they've been clarifying that what they mean by that is not permanent. So it still opens the question is exactly when will things calm down? So what do we expect looking forward, where the tapering got announced, the tapering kicked in here in November, and it's scheduled basically to cause them to end their security purchases roughly in the middle of 2022. The general consensus view is that interest rates won't really be addressed. The Fed funds rate won't really be addressed till that's over. So it could be the second half of 2022 or into 2023 in terms of Fed rate hikes. And the bottom line is there's a variety of views out there. Some folks believe a couple will happen in 2022. Others think that'll get pushed out into 2023, or maybe a split one action next year and a second in the following year. So the other open factor right now is whether Jerome Powell will be reappointed to be chair of the Fed. And Lael Brainard is sort of the possible rival. Those are the two individuals that the president has interviewed for the job. And honestly, the announcement is expected any day. So we'll see how that goes. Now, as it relates to the other side of support, government spending. So we finally have the bipartisan infrastructure package, a $1.2 trillion package that passed Congress and was signed into law just this week. So that's kind of behind us as it relates to kind of the work that's been going on in D.C. Now Congress is essentially focused on Build Back Better. It used to be $3.5 trillion. It's been scaled back to about $1.75 trillion. And, there's a view that that number could move around a little bit, as well as the timing. Our chief Washington policy strategist, Brian Gardner, says it's possible that this whole thing will get rolled into 2022. So we'll have to wait and see how that unfolds. And the bottom line is, we'll watch it carefully and communicate as we go along the impact of this legislation on, among other things, tax increases. There's no question that there will be tax increases embedded in the final legislation because they want to be able to demonstrate a way of paying for this spending. And it's just going to take some time to get clarity on exactly what will happen. Now, as it relates to the macro environment, we keep an eye on a lot of different risks. So just know we don't look at any one and worry, oh, this is going to happen. It's more about looking for the low probability events that could be problematic. So just know that we're keeping an eye on that. All of this work from a macro perspective rolls up to forecasts, right? So here's the table we like to show with Stifel's forecast, the consensus view, and then a bunch of other shops that are doing this work as well. And, bottom line is 2021 should end well above trend. 2022, most are forecasting for above trend growth. But if you look at the red parenthetical numbers, these are the forecasts from just a few weeks ago, back in early September. And you can see that not for all, but for the vast majority of these forecasters, essentially everybody's brought their forecasts down in 2021, given especially the disappointing results in the third quarter, or lower than expected results anyway. So let's turn to markets. We always like to start with the foundation of interest rates. So we've talked about the Fed funds rate being down near zero. Market rates have really bounced around. And even since the production of this chart, basically, just today, markets have gone up a little bit in terms of interest rates. The 10-year up, I think, to about 1.6%. So we're seeing it move around a little bit. We've talked about the break-even inflation rate, and then that corporate spread, basically that amount that investors get paid on average for investing in corporates rather than treasuries, sits just above 1%, which by historic standards is a very low level. And so whether it's absolute, sort of nominal rates in treasuries, the Fed funds rate, or spreads, everything is low relative to where it's been over the longer history. So it begs the question, well, where do rates go from here? Well, here's a chart that kind of takes into consideration, number one, the consensus view or forecast for the end of the year for the 10-year rate. And right now that's at 1.69%. Now, when we look in the yield curve and sort of take that to forecast the 10-year rate as it moves over the next 10 years, basically the market is forecasting it's going to take a full decade to move 1% to 2.5%. So again, it seems a little low to me, but again, that's what the market is signaling. On the equity side, we've told this story now for almost 2 years. 2020 was a volatile year with the big bear market as the pandemic became known, and then the very strong recovery, in part fueled by the existing and anticipated monetary and fiscal policy support. 2021 started a little volatile, but since roughly the end of January, overall markets have been up, and we're sitting at a year-to-date number for various equity market indices that are very, very positive. So 2021, touch wood, should come in as a positive year. People worry about valuation, and this next page basically shows us the traditional level or metrics of PE ratio. And so the two lines, one looking to historical or trailing PE or earnings, the other looking to forward earnings for PE. Bottom line is both are signaling quote unquote richly valued markets. But when we flip that around and look at the earnings to price ratio, it's basically an earnings yield. And we look at how that differs from interest rates, so the 10-year treasury or the aggregate bond yield. In both cases, we look at how much, essentially stocks are paying in earnings yield in excess of those baseline rates. Bottom line is that we're at a point where stocks are attractive, right? The dots here are sort of right above the median level of that excess yield. And that tells us that even though by traditional standards PE is showing a rich valuation, when we adjust for interest rates, basically more in the middle, more median in nature, and just above that actually. As we've talked about before, I think we've done some work looking at how the markets have shifted over time. And I think the important takeaway is to understand that the market, we see companies that have become dominant in tech and communication services, et cetera, that are basically faster growing companies. They become more dominant from a market cap perspective in the market. And that has been one factor that's led the overall market to have a consensus growth rate that's higher than some of the companies that have become less dominant or dropped in this case, the S&P 500 index. And that is one factor that helps support a bit higher of a PE ratio. So again, some analytical work we've done to understand that. The takeaway from earnings here on this next page has been that earnings have come out really in a series of positive surprises. And we're just finishing up third quarter earnings season, and the same exact thing is happening this last quarter, that we're seeing most companies, call it probably above 80%, surprising on the upside as it relates to what earnings were expected versus those that were actually produced. And that just creates some positive support for the equity market. Now, looking at a couple other things as it relates to companies and what might be coming, we tend to watch profit margin, for example. And I will say that we're mindful of things like the inflationary pressures and things like increased taxes, putting some headwinds on that. The other thing, which is more of a quality statement, is we do note that sort of the percent of companies that aren't posting positive earnings are up a little bit relative to normal levels. And that's especially true in the small cap space. Now, if you think about it, we've come through this severe pandemic, challenges of the pandemic and shutdown, so it's not overly surprising, but we're going to be watching to see that those numbers sort of calm down. Now, this page 38, I want to just jump to the idea of volatility during the year. So this is a chart we look at, and we have been focusing on 2021. So think of this as each bar being the calendar year return, thankfully a lot of positive numbers. And then the dots represent the intra-year biggest move, peak to trough down. And so what's super interesting is this is shaping up to be a pretty positive year. And yet when we look at that intra-year drop, negative 5%, which just happened just a few weeks ago, basically a little bit better than most of the other years presented on this page. What that tells us is that volatility has been lower than is typical. And hey, it wouldn't be surprising if we see another move down between now and the end of the year. Wouldn't be surprising at all. Okay, so to close out with our dynamic leanings and where to find our work. Basically, as I think our viewers now know, we sort of think of our asset allocation work as this structure where we create lots of choice about risk tolerance, risk preferences, time frames, whether one's a long-term strategic investor or dynamic investor, different levels of liquidity, which really relate to investing in alternatives, whether one likes to be U.S. or globally focused in equities, and then whether fixed income should be adjusted for tax status in terms of what kind of account it is, et cetera. And long story short, we have this framework, but we are able to think about and publish essentially our leanings against those strategic views. So in 2021 here, we've been overweight, large cap value and small cap within the U.S., but overall, our U.S. weight has been an underweight relative to our exposure to non-U.S. stocks. All of that sort of rationalized and sort of focused on recovery and the impact of recovery. When we look at our fixed income positioning, we've been overweight tips, which is a way to hedge against inflation. So as you might appreciate, those positions have performed well given all the inflation that we've experienced. And then we've been overweight for those that use active management, high yield investing. So if you're invested in high yield and you use active managers, we think we're very comfortable sort of increasing that weight a little bit because it's a good environment to find value and add value in high yield. In any event, basically, final page in this slide presentation, if you see it digitally, is a set of links to our work. We really enjoy bringing you this monthly video, but invite you to check out all the other work that we do. And feel free to consume it as you see fit. So, hey, we'll come back to you in December for our last session as it relates to investment strategy brief. But until then, thanks so much for watching, and we'll talk to you next month. Thank you.